I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Well, Ross, at least we know we had one listener for This Week in Money. After this past weekend's This Week in Money show, we had you talk to us extensively about real estate, and a listener was wondering if you could explain your comments on inflation being a homeowner's best friend and a tenant's worst nightmare.
Yeah, so we're starting to hear the Bank of Canada, Statistics Canada, talking about inflation starting to impact the economy again, and the Bank of Canada talking about raising rates to keep that inflation in check, I guess. Of course, as we are going to learn, because the country has not experienced this since the early 1980s. What happens in a rising interest rate environment, and we know that based on historical review of the data, that when interest rates rise, they have a certain amount of inflationary pressure themselves. They cause a certain amount of inflationary pressure themselves. So it's almost like a self-fulfilling prophecy. I suspect sometime after this cycle is over, 10, 15, 20 years from now, economists will look back at this time, and they'll probably be able to have some conclusive evidence about the impact of inflation rates rising, causing inflation to rise. That said, as a homeowner, even though higher inflation generally means that we're going to see higher interest rates, the benefit to the homeowner is that in a rising interest rate environment, the homeowner wins. And the homeowner really wins on two fronts. And this is where you look at the homeowner and the tenant situation. The question, is it better if I rent or I own? This is really it's really going to be evolutionary here as we move forward, Jim, because we haven't been in a market with rising interest rates since the early 1980s. What happens when interest rates increase, when inflation increases? Your monthly payment stays the same for the given term of your mortgage. What I mean for that is if you are in America where you could choose to have a 30-year term on a 30-year mortgage, if your mortgage payment is $1,000, it is $1,000 for the next 30 years until your mortgage is paid off. It doesn't increase, it doesn't decrease, because you've taken a fixed term 30-year mortgage. In Canada, we don't have that option. The most common mortgage that is taken out is a 5-year fixed term, which is what Canadians, the practice they followed for a very long time. But there are also 10-year terms that are available. So you can get a 10-year term mortgage. I have always, throughout the years, used the 10-year rate to establish a baseline to determine whether or not someone is suited for owning a home. But for the person who takes advantage of a 10-year mortgage, what it means is that you have, for the sake of the argument, we're going to go back to the American example where they can take out they can take out a mortgage with a 30-year fixed term interest rate with a payment of $1,000. Your payment of $1,000 effectively becomes smaller and smaller and smaller with each passing year as inflation impacts that $1,000 payment. If you were to ask anyone today, hey, if you could buy this nice 2-story detached home for $1,000 a month, would you buy it? Almost everybody would say yes. If you look at the exact same house and you ask someone, hey, would you buy this home for $2,000 a month? A lot of people would say no. The difference is, when did you buy the house? In America, if you purchased that house 30 years ago, you have had the exact same $1,000 a month payment for 30 years. What was $1,000 in 1988 is not worth $1,000 today because of inflation. You have effectively made your mortgage interest payment, your mortgage payment during the last year, the 29th year that you're making it. It's basically half of what you would have paid in the very first year that you made your mortgage payment, even though you're still paying $1,000. The difference is 30 years ago, it was a $1988, and today it's a $2018. After 30 years of inflation has devalued what you're able to buy with that money. The tenant, on the other hand, who's rented for 30 years, would have seen 30 consecutive increases in their rent indexed to inflation. Pretty much even in rent control situation like we have here in Ontario for buildings that were built in the 1980s and or for a property where the same tenant stays in it year after year after year. Rate increases are indexed to inflation. Whatever inflation is, the government says the landlord can increase the rent by that amount. Most tenants are extremely happy only to have their rent increase with inflation. But after 30 years, your rental payment effectively doubles. Well, more than doubles. But to make a long story short, for the sake of the comparison, let's just say that it doubles over the 30 years. Your mortgage payment does not. In a 30-year term mortgage, it stays exactly the same. Canadians need to use that perspective when they're looking about home ownership over the next 10, 20, 30 years. Because in a rising interest rate environment, with rising inflation, the term of your mortgage means that the longer the term, the less real dollars you were spending with each passing month. And you need to take that into consideration.
Ross, something I just want to jump in and say, would you be better off to pay your mortgage every 2 weeks or every week? Would that save you a lot of money and get your mortgage paid off sooner and you would have that equity built up faster?
For probably 20 years, I mistakenly would have given that advice, Jim. Probably for 20 years, I would have given that advice to people. And it was a mistake during that entire 20 years that I would have given it to them. Right now, there's a podcast out there about burning your mortgage. You know, everybody talks about burning your mortgage, paying it off as quickly as possible. The worst thing possible is to pay off your mortgage in dollars today that those same dollars are going to be worth less 10, 20, 30 years from now. It simply makes no sense. Now, there is a ratio, there is a spreadsheet that you should be going through to decide where that break-even point is, where yes, I should pay down or I shouldn't be. But to make a long story short, you are far better to take any money you would have put towards the principal and invest it somewhere else and let it grow. And this is why, Jim. As inflation is making your monthly mortgage payment smaller and smaller and smaller in real dollars, as inflation impacts the dollar, your house is also increasing in value. And even if your house only increases with inflation over a 30-year period, inflation protects your original purchase price. So if you spent $100,000 30 years ago, and inflation in your house has increased with inflation, and now it's sitting around $280,000. Excuse me, you start at $150 and now it's worth around $280,000. Your money has been protected against inflation. There are only two things out there, Jim, that do this: gold, the gold standard. People invest in gold simply as a hedge against inflation. Very few people are speculative on gold. And your home. Your home protects your money against inflation, and very few people speculate on home. A homeowner needs to look at their monthly mortgage payment and the value of their home in correlation with what inflation is going to do to both. And only when you have an understanding of that do you understand why home ownership is the best investment advice anyone can give you. It's why the banks don't worry. You take out a 5-year term. At the end of the term right now, because of inflation, your real mortgage payment is going to be about 8% less than it was at the start of the 5-year term. Your house is going to have increased about 8% just with inflation. Your wages normally for a homeowner, the homeowner is the person who normally gets at least an inflation adjustment to their wages every year. So when your mortgage comes up for renewal 5 years later, even if interest rates are 2%, you are in a position to be able to handle it. At the same time, the longer your term, the longer you let inflation whittle down on that mortgage payment. Now, you've got to be careful because of what the banks are doing right now, but it's a concept that your listeners must understand because the experience for them is going to be totally different than those people that have owned their homes from around 1982 through till 2018. On the way up and the increasing part of the interest rate cycle, rising inflation, things have to be looked at a little bit different.
We'll have more with Ross Kay right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ross Kay. Ross, we're now hearing suggestions the summer months are creating a buying opportunity in the greater Toronto and Vancouver areas. Do you believe this opportunity really exists? And if so, what do you recommend?
The buying opportunity is an illusion. It's the same illusion that people in Vancouver have experienced over the last year and a half with condominium price. The housing market works in the same way. It works in the same way always. Right now, you are in a correcting housing market in both Greater Toronto and Greater Vancouver. No matter what a real estate agent tells you, no matter what seasonally adjusted stat they throw at you, no matter what they tell you about, the supply is more, so you have a better selection of homes. Now's the time to get in before demand picks up and that supply benefit that you have is gone. Those are all sales costs. That's all sales technique. None of it is supported with the data. The data shows that Vancouver right now, for the sake of the argument, Jim, your listeners don't understand this. It is now substantially lower than what it was after the foreign buyer tax was implemented and the rising interest rates hit the market and that $37,000 bump to condominium first-time buyers of condominiums happened. Your market is slower now than it was then. It is going to get slower. Prices are going to fall further. This is simply how a real estate market functions. Do not believe anybody who tells you this is an opportunity to buy. When the market turns over, there will be signals that will tell you you have a real opportunity to buy. Buy at the trough. Don't buy any time else. If you buy at the trough, your 25-year rate of return is going to be massively bigger than everyone else.
Ross, last week the Bank of Canada increased their lending rate, and then a day or two later we heard some banks were lowering their rates and were offering a discounted mortgage. You warned listeners about this in previous shows, and a listener was wondering how you knew what the outcome was going to be when no one else was making those claims.
Because we track the mortgage books of the bank. In other words, we track, Jim, how much mortgages the banks are going to book in brand new mortgage debt. So your listeners have to understand, banks are shedding mortgage debt with every monthly payment you make. The banks need to replace that mortgage debt. If the banks are not replacing that mortgage debt, or not only replacing it, but increasing the amount that they're lending, then their profits are going to decrease and their CEOs are going to be under pressure. This has been consistent for the 30 years that we have tracked it. We also know that in these situations, the immediate response of the bank is a strategy used to try to take customers from other banks. And you will see certain banks offer mortgage discounts even when the Bank of Canada raises their interest rate, which is what we've warned about in your show before. They manipulate you. The banks manipulate homeowners and home buyers. They have done it for 30 years. And that's what's going on right now, Jim. What you're seeing right now is the Bank of Canada raised their lending rate by 1/4 point. Within 3 days, 2 or 3 of the banks were offering lower discount, bigger mortgage discounts. You also see, which you haven't watched reported in any newspapers, Jim, because of this new B20 rule, none of the banks raised their posted 5-year rate. So this is exactly what the OSFI intended, that all of these mortgage guys out there that have been talking had no idea what was really going on. The OSFI made this rule, the B20 rule, so the Bank of Canada could raise the rate, but the banks themselves didn't have to change the mortgage qualification rate. And that happened last week. What we've been saying on your show for over a year and a half about B20 being so misunderstood by everyone was just proven to be true. Last week, the Bank of Canada raised the rate. The banks chose not to raise their 5-year posted rate because the mortgage qualification rate is based on that 5-year posted rate. It's an average of the Canadian banks. They take an average of the Canadian banks, and that's what it comes up with. The banks strategically decided not to raise that. They also decided to play around with their mortgage discounts as they are now fighting for your business. Don't believe everything you've heard about shrinking credit or problems with B20. The banks are so greedy to lend you mortgage money because it is such a low risk for their bank because of the Canadian homeowning infrastructure. They are fighting to lend you mortgage money. All but the most risky Canadian can walk out there today and negotiate a great mortgage discount. Just to make sure that you're negotiating what's in your best advantage and that's relevant to your specific situation.
We'll have more with Ross Kay right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Ross Kay. Ross, it's been suggested the real estate market in China has fueled a massive credit bubble around the globe today. What are your thoughts on China's real estate market and its impact on Canada?
Well, because the sheer magnitude of the size of the real estate market in China, the real estate market in China impacts every country in the world today, including the United States of America. It impacts it in this way, Jim. The more money, credit, that is lent to Chinese home buyers in China, the higher the house price gains go, and the more money can be lent again. It's a cyclical pattern that follows itself over and over again. What's different between China and Canada is when it happens in Canada, we are not big enough that this infusion of capital with Canadians buying houses, it's not big enough to impact the world. China, on the other hand, is totally different. And you've seen that in Vancouver, where you saw some foreign buyers buying into your market. There was so much money available to be mortgage debt able to be secured in China that some of the money they were able to get out came over to Vancouver and bought up some Vancouver homes. Some of that money went to Seattle, bought up Seattle homes. Some of that money went to London, England, bought up those London, England homes. That is all fueled, though, like you said, on a credit bubble or a mortgage lending bubble. Now, because a mortgage lending bubble is self-fulfilling, it's a self-fulfilling prophecy. The more you lend, the higher the prices go, the more that can be lent. It just goes around in a circle and a circle. It's why we call it the home equity pyramid. It's a pyramid scheme. And sooner or later, that bubble is going to burst. And I think we're seeing signs of that in China right now. Their currency is being devalued, and I believe the government knows their real estate market is going to go into a full crash, and that by devaluing the currency during a crash, things don't look as bad as what they really are, because of what they're able to do with their money. It's also a way of repatriating money. So any money that's out there, if your mortgage is coming up for your condo in China and you can't refinancing because lending is tight, you're going to bring money back into your country from outside of it, or you're going to immigrate, one or the other. So that's what's happened. That's what's happening with this, the Chinese market and the Chinese real estate market and how it impacts the world. China is unique to every other country in the world. The United States is not going to impact the world economy with their housing bubble. Yes, there was fear and panic in 2008 when all the false headlines appeared about their problem. But the American problem was very easily solved. That problem could have been solvable within 2 months of the credit crisis hitting. That cannot happen in China. The sheer magnitude of the amount of money that's been borrowed based on artificially inflated house prices, house price illusion, is probably a world record. And as that credit bubble comes around, there is going to be a ripple effect across the globe, including here in Canada and including those ultra luxury class homes in Greater Vancouver.
Ross, we'll save that for another show to see what the ripple effect will be and how it might affect you.
Hey, thanks a lot, Jim.
My guest has been Ross Kay. He's a home ownership consultant out of the wealthyhomeowner.ca. You're listening to HoweStreet.com radio. Our popular YouTube channel is Talk Digital Network. Find us on Twitter at HoweStreet. Questions for the show or for Ross can be sent to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.